Welcome to the deep dive. Today we're really getting into the weeds on Duolingo. We're doing a proper deep dive into their Q3 2025 financials and what it all means for their momentum. Our goal here is pretty simple. Cut through the jargon, highlight what's really driving growth and profit so you understand the core health of the business. And yeah, we have to start with that big headline number, Q3 net income. $292.2 million. I mean, that's just a massive leap from $23.4 million last year, and this is a big but, we need to put that into context straight away. It's really not what it looks like on the surface.
Absolutely. That's the right place to start. We've gone through the shareholder letter, the CFO's comments, all the financial tables. And the main story for Q3 25 is, well, continued strong top-line growth, really solid user growth, actually, and record operational profitability. But yeah, before we get too excited about that nearly $300 million net income figure, we absolutely need to unpack where their real operational strength is coming from.
Okay, so let's start with the engine room, right? The users. That's always where the Duolingo story begins. The scale is just... it keeps growing. Monthly active users, MAUs, they hit 135.3 million in Q3. That's up 20% from last year.
Yeah, 20% is solid. But the metric I find even more telling for a platform like this is daily active users, the DAUs. That tells you about habit formation. And that metric grew even faster, 50.5 million DAUs. That's a 36% jump year over year. Hitting 50 million DAUs, that's a big milestone for a daily learning app.
And what's really interesting about that 36% DAU growth, it wasn't compared to an easy quarter last year, was it?
Not at all. That's a key point in the source material. They hit 36% growth even when they were comparing against a really strong Q3 2024. And that quarter itself grew 54% year over year.
Wow.
So yeah, this isn't just some temporary spike. It suggests, real sustained momentum. It tells you their product tweaks, the content, their notifications. It's all working to keep people coming back day after day.
And crucially, that daily engagement, that stickiness, it's turning into paying customers, right?
Yeah.
The paid base is growing almost exactly in line with the daily users.
Exactly. Paid subscribers grew 34% year over year. They ended the quarter at 11.5 million. Seeing that 36% DAU growth converting almost perfectly into 34% paid subscriber growth, that really confirms the funnel is working efficiently. They're not just adding free users who drop off, they're converting them consistently. It shows the paid tiers offer real value that people are willing to pay for.
Okay, let's pivot then. Let's talk money, the financials. Total revenue grew 41% year over year, hit $271.7 million. And no surprise, subscription revenue is the big engine there, growing even faster at 46% year over year. That's $229.5 million just from subs. But here's where it gets strategically interesting, I think. It's not just about more subscribers. It's about getting more value per subscriber. The documents talk about a successful mix shift towards the pricier options. They specifically call out the max subscription and the family plans.
Right. And this is where you see their pricing strategy paying off. It's maybe a stronger signal of business health than just user numbers alone. This shift, this move to higher tiers, it drove a 7% year-over-year increase in what they call ARPU, the average revenue per paid subscriber.
7% ARPU bump. Okay.
Yeah. And that 7% tells you two things, really. One, they've got pricing power. People value it enough to pay more. And two, their strategy to upsell people into those premium packages, it's working. That 7% gain basically acts like a turbocharger on top of the user growth.
Makes sense.
We should probably also quickly mention currency, since they're global. Total bookings grew 33% as reported, but if you adjust for currency swings, they call it constant currency, it was more like 31%. So a slight headwind from FX this quarter, but it just reminds you, more than half their business is outside the U.S. That adds a layer of complexity you always need to watch.
Okay. Let's finally tackle that huge net income number, $292.2 million in Q3. It just looks like incredible profitability. So why are we saying look past it?
Because fundamentally, it's a giant one-off accounting adjustment. It has almost nothing to do with how the business actually performed operationally day to day or the cash it generated in the quarter. That number was massively inflated by a $222.7 million one-time income tax benefit.
A tax benefit. Okay, break that down.
So think of it like this. Duolingo had previously set aside a big reserve, it's called a valuation allowance, against some potential future tax savings, these things called deferred tax assets. They did that because, historically, they weren't sure they'd actually be profitable enough down the line to use those tax savings.
Right. Standard practice for growing tech companies.
Exactly. But now, because they've shown sustained profitability and they've raised their future forecasts, they decided, okay, we will actually be able to use these tax savings. So they released that reserve. That creates this huge non-cash tax credit on the books, which flows straight to the net income line. It makes the quarter look way more profitable than it was from just selling subscriptions.
Got it. That context is absolutely critical.
Huh.
So if we ignore that massive one-time accounting quirk, what's the real measure of their operational strength? We need to look at adjusted EBITDA.
That's the number you want to focus on. Adjusted EBITDA, which strips out things like tax, interest, depreciation, stock compensation, and now acquisition costs. It basically measures their cash profitability from the core business, and that hit a record $80.0 million. That's up 68% year over year.
68%. That's still really strong growth.
It is. And just as importantly, the adjusted EBITDA margin expanded significantly. It went up by almost 5 percentage points to 29.5%. That shows real leverage. They're getting much more profit out of each dollar of revenue as they scale.
That kind of margin improvement alongside 41% revenue growth, that's pretty impressive efficiency. But hang on, I noticed something in the footnotes. Didn't they actually change the definition of adjusted EBITDA this quarter? Does that 68% growth figure compare apples to apples?
Good catch. You're absolutely right. For anyone really digging into the details, they did tweak the definition starting this quarter, Q3 2025. They expanded it slightly to also exclude integration costs related to acquisitions.
Okay.
Now, those costs are usually pretty small compared to the overall $80 million EBITDA figure, but yes, technically it's a slight change in the yardstick. The growth is definitely still very strong and real, but it's a nuance worth knowing. They provide a reconciliation in the appendix if you want to see the exact impact.
Right. Transparency is good. Okay, let's talk costs then. Despite that great operating leverage, the gross margin actually dipped slightly, down about 40 basis points from last year to 72.5%. Why did that happen when everything else seems so efficient?
Yeah, they were quite clear on that. The pressure on gross margin, which is basically revenue minus the direct cost of delivering the service, came from increases in generative AI costs and hosting costs.
The AI tag.
Pretty much. That's the reality now for tech companies pushing hard on AI features. They're investing heavily in these computationally expensive tools to make the product better, more personalized, maybe add new features. And that immediately brings up a really important question, doesn't it? How are they managing to absorb these higher tech costs and still deliver record operating profit?
And the answer seems to be that operating leverage we talked about. They must be managing their other costs really tightly.
Exactly. They manage their operating expenses, things like R&D, sales and marketing, general and admin, incredibly well, both on the official GAAP numbers and the non-GAAP figures. That tight control on overhead is what allowed them to absorb the increased AI spending at the gross margin level and still push that adjusted EBITDA margin up so much. They're being super efficient everywhere except the direct cost of running the servers and AI models.
And that efficiency shows up in the cash flow, too.
Absolutely. Net cash from operating activities was up 50% year over year, and free cash flow, which is operating cash flow minus capital expenditures, was up 51% year over year, hitting $77.4 million. So this isn't just paper profit. The business is genuinely throwing off a lot more cash, which gives them a ton of flexibility for future investments or whatever else they want to do.
Okay, so strong Q3, strong cash flow. Naturally, they raised their guidance for the full year. What did the revised outlook tell us?
Yeah, it definitely confirmed their confidence. They bumped up the full year 2025 guidance pretty much across the board. If you look at the midpoint of their new ranges, the projections look very healthy.
All right, let's hit the key numbers. Full year 2025. Bookings, they now expect those to grow 33% year over year. That's a little nudge up from before. And full year revenue growth, expected at 38% year over year now.
And maybe the most important signal of that ongoing efficiency. The full-year adjusted EBITDA margin guidance was raised quite a bit. They're now targeting 29.0% at the midpoint. That implies an expansion of about 330 basis points or 3.3 percentage points compared to last year. So they expect to maintain that strong operating leverage right through Q4.
Now, let's go back to that tension between AI costs and profit. You mentioned the gross margin pressure. Was there anything in the updated guidance about that?
Yes, and this is actually quite interesting. While they still expect the annual gross margin to be down slightly year over year by about 80 basis points because of those ongoing tech costs,
Right.
That forecast is actually a 20 basis point improvement compared to what they guided previously.
Oh, okay, so the hit isn't quite as bad as they thought.
Exactly. It suggests that the actual costs for running their generative AI systems and hosting in Q3 came in a bit lower than they had originally budgeted for. That gave them room to slightly improve the margin outlook for the full year.
Interesting nuance. And just one final reminder about their global reach.
Yeah, always worth remembering. Over half their bookings are from outside the U.S. currency matters. Remember, we said full-year bookings growth is guided at 33% reported? Well, on a constant currency basis, stripping out FX effects, it's guided at 32%.
Got it.
That 1% difference just highlights how much those global currency movements can sway the final numbers you see reported.
All right, so let's wrap this up. If we boil down this whole deep dive on Q3, the story isn't really about that flashy net income number driven by the tax benefit.
Not at all. The real story is robust and sustainable user growth, especially those daily active users. It's about successful conversion and upselling. That 7% ARPU growth is key. And it's about really impressive operating leverage, allowing them to absorb significant new investments in AI while still dramatically improving their underlying profitability. High growth and increasing discipline happening at the same time.
The scale is undeniable. The efficiency gains are clear. They've shown they can grow fast and generate serious cash flow together.
Definitely. But maybe this leaves us with a final thought, something for you to mull over. Duolingo is clearly investing heavily in AI, which is pushing up their direct costs, their gross margin is feeling it, yet they actually raised their annual profit guidance, partly because those AI costs came in lower than they feared this quarter. So the provocative question is, how will this fundamental tension between needing to invest aggressively in cutting-edge AI to stay competitive and the financial discipline needed to keep expanding margins? How will that play out over the next year or two? That balance, innovation versus cost control, feels like it will really shape the next chapter of their profitability story. Something to watch.